Most investors know how to sell covered calls, but very few know how to roll them the right way for more income, better positioning, and higher returns. In this video, you'll learn when, why, and how the pros roll their covered calls like clockwork. I'm Mike Bellafiore, co-founder of SMB Capital, home to elite 7- and 8-figure-a-year traders. You found the right place to help grow your trading account.
Hi, I'm Seth Freuberger, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if you are a trader or investor looking for cash flow, you may have heard that options traders employ a strategy known as the covered call to collect cash flow. And this strategy is a very effective technique for squeezing cash flow out of your existing equity investments. At the same time, you'd like to understand how professional options traders deploy covered calls in their trading practice to maximize the profits they make with this strategy. And that's exactly what we're going to be covering in today's video. If you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be discussing today. Then when you're finished, you can come back and watch the rest of this video. The basic concept of a covered call is pretty simple actually. For every 100 shares of a stock that you own or are interested in buying, even if the stock issues a dividend, you can bring in way more cash flow from the same investment, far beyond what you could make on that stock's dividends through selling covered calls on those stocks. So let's head back to the third Friday in February of this year, which was February 21st. And we picked the third Friday of the month intentionally because it's a traditional expiration date for options historically. And most options contracts have an options chain that expires at least on the third Friday of the current month, as well as future months. So it's a reliable day in each month to start a trade if you're looking to make a multi-month trade. And so let's suppose that on that day, you were interested in buying Walmart stock, WMT, and you wanted to make some extra cash flow from owning the shares. And even though WMT does in fact pay a dividend, it doesn't even yield 1% annually. And so therefore, it's not going to produce very much cash flow simply as a stock investment. And so on that day, WMT, after staging a very strong rally in all of 2024, closed at 94.78. And so let's say that on that day you decided to enter into a covered call program on Walmart shares, and you went ahead and bought 500 shares of Walmart at that closing price, but simultaneously you pulled up an options chain, which expired on the third Friday of May, about 3 months out, which was the May 16th expiration. And you went ahead and sold 5 of the 97.5 WMT calls for a price of $3.20 at a strike price very slightly above where the stock is trading. And so now you've entered into a covered call trade on Walmart, which expires in about 3 months. And when you enter into a covered call, you do, of course, have to buy the shares, which in this case would have cost $47,390 to pick up those 500 shares. But at the same time, you're getting some of that cash back because when you sell those calls, you receive the price of $3.20 for each of those. But remember, selling each call option requires you to sell 100 shares at that strike price of 97.5 if the stock rallies beyond 97.5 and it's exercised. And so you multiply that price by 320 and you sold 5 of them. And so that results in total cash inflow from those calls of $1,600. And so the net cash outlay is actually $45,790 that day when you enter the trade. Okay, so now let's move to the day that this trade expired, which was May 16th, as we mentioned earlier. And as you can see, after initially selling off after we entered the trade on February 21st, Walmart bounced, closing at 98.24 on the day the trade expired. And so our shares will be called away at a price of 97.50, even though the shares are trading higher than that, which is our obligation, of course, if we sell covered calls. And so let's take a look at the outcome of the trade. And as you can see, with those shares required to be sold at 97.50 per share, we collected 48,750 from that sale. And remember, we collected $1,600 in cash for selling those calls originally, which we get to keep, of course. But then we have to deduct out the original share cost of $47,390, resulting in a net trade profit of $2,960. But could we have gotten more out of this trade? How would professional options traders have handled this trade? Well, that's going to get interesting because although we'll stay with that same starting point, selling those 5 calls on February 21st, collecting $1,600 in covered call premium and netting our upfront outlay to $45,790, this time we're going to implement a rule that if the call's premium drops more than 80% from its original premium level of $320, we're going to buy it back and close that call position. And when will call's premium drop? Well, there are actually many factors that go into an options price, but the most obvious and powerful one is a drop in the stock price, making the right to buy the stock at the original strike price less valuable because the stock would have to rally a lot farther to hit that strike price by the time the option expires. And in fact, that is exactly what happened on March 18th, when, as you can see, in the middle of tariff concerns, Walmart dropped substantially, closing that day at $85.59. And so turning to our options trade, as you can see, the call options price has dropped dramatically, down to 61 cents, which is less than 20% of its original value when we sold it. And that makes sense, right? Because the 97.5 call is the right to buy the shares at 97.5. But with the stock having dropped more than 7 points since we initiated the covered call trade, the right to buy the shares is less value because now the stock has to rally much farther than it would have had to rally in the beginning for that right to have any value by expiration. And since more than a month has passed, the stock now has less time, less than 2 more months at this point to rally and make the 97.5 call option valuable again. And so, as we said earlier, the way a professional trader would handle this is to buy that call back for that 61 cents at this point, which results in a profit of $12.95 out of the possible $1,600 that we could have possibly made out of the trade, because the best case scenario for short calls is that they expire worthless, in which case we get to keep the entire $1,600 initial cash flow as our profit. But in this case, we bought it back for a lesser profit of $12.95, but we've captured 80% of the potential profit of the trade. Okay, so remember, at this point, we still own the shares. We haven't sold that position at all. And so there's 2 ways this can go. Either the stock never gets back to 97.5 before May 16th, in which case we've made $1,295 on the covered call position, and we still own the 500 shares of Walmart. Or the stock can rally and start working its way back to its original price when we first started the trade. And so I'd like us to move to May 2nd, a few weeks before the trade expires. And as you can see, after the administration announced in early April that it would put a pause on its tariff program to allow for more time for negotiations to take place, Walmart and most other stocks rallied, pushing the stock up to $98.75 at the end of that day. And so what's interesting is that now that the stock is actually pushed past the original call option strike price of 97.5, if we pull up that same options chain, we see that not only has the price of the 97.5 call option increased, it's actually now trading for more than the original calls we sold, which were priced at $320, if you'll remember. Instead, they're now at $357. And so at this point, we could sell those 5 calls again, this time for even more, receiving $1,785 in cash for selling this set of calls, more than we received earlier. And now if we move to the day that these calls expire on the original trade expiration date of May 16th, if you'll remember, the stock closed at $98.24 on expiration day. And so as before, our shares will get assigned away at a price of $97.50. That hasn't changed. But this time, the outcome of the trade is different, isn't it? Because in this case, in light of the fact that we bought back the calls when they had dropped in price and then resold them after the bounce, we not only recognize the profit we received from buying back the first set of calls we originally sold back in February, but this time we get to recognize the cash received from the second set of calls, we double dipped, meaning that our profit now climbs by the amount of the cash flow we received from that second set of calls. The ones we sold on May 2nd for $17.85, which have now expired. And so that premium is fully earned and the shares have been assigned away. And so with the shares gone and the calls are either bought back or expired, the trade has been completed. But this time for a total profit of $4,440, an improvement of 50% over the first example, where we simply allowed the first set of calls to expire and did not buy back and resell as we did in the second case. And so what I'd like you to take away from today's video is that both methods can produce a trade profit, no doubt. But professional traders go the extra mile and recognize when they can scalp a profit out of a trade, reload the trade with premium if the stock bounces, and basically get two trades in one, with the result being even more profit than you would have expected, sometimes a lot more profit. And that's because professional options traders are trained to take advantage of these kinds of trading opportunities. When the remaining potential profit in a trade has become a small fraction of its original full potential, then smart professional options traders close the trade for most of the profit they could have received had they waited, but setting themselves up for a potential double dip, like happened in this case, in which case your profits can be greatly enhanced. That maximization of trading profits is what distinguishes experienced professional options traders and helps them to attain superior returns.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.